What if I told you that one of the biggest future metals of the 21st century, the metal promised to power electric cars, the metal billionaires said would reshape global supply chains, the metal investors treated like the new gold was at the center of a scandal so large that it almost broke the global commodities market? What if I told you a single trade from a single Manin, a single night created a $15 billion margin call, bankrupted firms, froze markets worldwide, and exposed a hidden weakness in the global financial system? And what if I told you that all of this happened because the world believed a story about endless demand, limited supply, and guaranteed profit? Until one day, the entire illusion collapsed. This is the nickel boom. A bubble fueled by hype, greed, geopolitics, and one trader's desperate gamble. A bubble that promised billions and delivered a historic crash before the meltdown, before the failed trades, the frozen markets, and the finger-pointing nickel was being marketed as the most important industrial metal of the next century. Electric vehicle companies said they needed it. Battery developers said they were running out of it. Politicians said it was the next strategic resource like oil in the 1970s. Between 2016 and 2021, nickel prices surged. Commentators said this was the beginning of the nickel supercycle. A once-in-a-lifetime explosion. Hedge funds poured in. Banks created new derivatives. Mining companies raised billions. Speculators bought every dip. This wasn't just a commodity. It was a promise, and like all promises on Wall Street, this one would be broken. So why did nickel suddenly become the new oil? Several forces collided at once. First, electric vehicles. The lithium-ion batteries used by Tesla, BYD, and dozens of automakers require huge amounts of high-grade nickel. Manufacturers were constantly warning of shortages, creating a sense of urgency. Second, supply constraints. Only a few countries produce the high-grade nickel needed for batteries. Indonesia, the Philippines, Russia, Canada, and New Caledonia. Any disruption, whether it's weather, geopolitics, or sanctions, could cause prices to spike dramatically. Third, the green energy push. Governments worldwide were promoting renewable energy, creating a massive wave of investment and buying pressure for all the necessary materials, including nickel. And finally, market speculation. With all this hype, financial funds started speculating that the metal would double, triple, maybe even hit record highs. By 2021, everyone seemed to believe that nickel was destined for the moon. But no one was asking a simple question. Who was on the other side of all these bets? Who was shorting the market? Who was betting billions that nickel prices would go down? Even as the world screamed, they were going up. Enter Xiang Guangda, known in China as the big shot. Xiang wasn't a Wall Street billionaire. He wasn't a hedge fund titan or a celebrity CEO. He was a Chinese industrialist, the founder of Tsingshan Holding Group, the world's largest stainless steel producer. And Tsingshan had a secret. They had developed a revolutionary new process that allowed them to convert low-grade nickel into high-grade material, the exact kind used in batteries. This breakthrough meant something huge. Nickel wasn't as scarce as everyone believed. In fact, a flood of new supply was coming. Convinced that prices had to fall, Xiang placed a series of massive short positions on the London Metal Exchange. Not millions, not hundreds of millions, billions. He bet the house. And for a little while, he looked like a genius. Nickel prices dipped. His short position looked brilliant. Until suddenly the world changed. In early 2022, Russia invaded Ukraine. This was the spark that ignited the explosion. Russia is one of the world's largest producers of refined nickel. Within hours, investors panicked, fearing that sanctions would choke off supply. Funds piled into long positions. Banks started calling in collateral from short sellers. Buyers went wild. The price of nickel was stable, rarely dramatic went. Completely vertical. From around $20,000 per metric ton, it rocketed past $30,000. Then $40,000. Then, In one of the most unprecedented moves in commodities history, nickel soared past $100,000 per ton in the early hours of March 8, 2022. That wasn't a rally. That was a nuclear explosion. And at the center of the blast was Xiang Guangda. His short position, once a smart hedge, was now a ticking time bomb. He owed billions. His brokers demanded cash he didn't have. Banks begged regulators to intervene before the entire system imploded. Then came the margin call, $15 billion. Overnight, no trader in history could afford it, not even the big shot himself. As nickel prices reached absurd, impossible levels as Xiang's positions threatened to drag down banks, brokers, and investors, the London Metal Exchange stepped in. They did something almost unheard of in modern finance. They canceled trades, tens of billions of dollars worth of legitimate transactions, simply erased from the books. Some investors who were about to make generational profits suddenly lost everything. Others who were on the verge of catastrophic losses were miraculously saved. And the market itself, frozen, halted for the first time in decades. The world's largest, most respected metals exchange had broken, and the trust in the system gone. After the freeze, the backlash was immediate and furious. Hedge funds accused the LME of corruption and saving its preferred members. Banks accused Xiang of market manipulation. Xiang accused the market of irrational panic. And the regulators, they accused no one, yet looked guilty of everything. Lawsuits began piling up, with billions in claims. Meanwhile, the real-world impact was chaotic. Global nickel buyers were EV manufacturers, steel producers, battery makers. No one knew the real price anymore. Some companies were forced to pay triple what they expected. Others delayed major projects. Some even went bankrupt. The shockwave didn't just hit traders. It hit the global supply chain. To save face, regulators tried to perform CPR on the broken market. They created new price limits, forced more transparency in trading, required daily reporting of large positions, and increased collateral requirements. But the damage was done. Nothing could undo the image burned into traders' minds. A market that cancels legitimate trades is a market that doesn't work. Participation dropped. Liquidity dried up. Some hedge funds stopped trading nickel entirely. For the first time in years, people genuinely feared that the metals market could collapse, because the nickel crisis exposed a hard truth. Modern finance is far more fragile than we think. The nickel boom wasn't a fluke. It followed a script we've seen again and again. First, you have a story of unlimited demand, just like dot-com stocks, housing in 2008, or crypto in 2021. Narratives become markets. Second, a supply shock triggers panic. Think of the oil embargo, the COVID supply chain collapse, or semiconductor shortages. When supply tightens, fear takes over. Third, leverage accelerates the chaos. Xiang wasn't the first to blow up using borrowed money. He joined the ranks of long-term capital management, Archegos Capital, and the Hunt Brothers Silver Squeeze. Every crisis becomes catastrophic when leverage is involved. And fourth, regulators fail at the moment of truth. By canceling trades, the LME may have saved certain institutions, but they destroyed trust, and trust is the foundation of every market. So, what are the takeaways? First, markets don't reflect reality. They reflect storytelling. Prices rise not because of facts, but because of belief. When that belief breaks, so does the market. Second, leverage turns small problems into catastrophes. A bad bet becomes a global crisis only when borrowed money magnifies it 100 times over. And third, regulations often protect institutions, not individuals. History shows this time and again. Markets are free until the wrong people start to lose. Then the rules get rewritten. Nickel won't be the last metal bubble. It won't be the last short squeeze or the last market freeze. As long as leverage exists, speculation thrives, and powerful narratives dominate, this pattern will repeat. The next boom is already brewing, maybe in lithium, maybe in uranium, maybe in some rare earth metal we haven't even heard of yet. But the ending, that part, is always the same. If you found this story eye-opening, and you want more deep dives into forgotten crises, market illusions, and financial mysteries, then hit that like button, subscribe, and turn on notifications. Because history may not repeat perfectly, but it rhymes more often than we think. Thanks for watching.